Tesla stock at the time of recording this video is down over 3% today. And you'll never guess why. Because we actually seen 13,500 Teslas that were insured in China last week, the best week of Q3 so far. This is also about 30% better than the same week last year, where you only had 10,600 registrations, and then comparing to 2022, this is over 130% better than the 5,117 registrations that we seen in this same week. So we actually got some good news today, and there's other good news that we'll talk about here in this video, but let's go over some quote-unquote bad news. And this is the reason Tesla stock sold off today, in which you can actually see Tesla stock was trading as high as $236 in pre-market and instantly sold off all of that gain to go negative in the first couple of minutes of the day. As this article says from Barron's, Tesla recalls 1.8 million cars. That's not causing the stock to drop. This is again just another software update to prevent the hood from opening while you're driving. But this is not a big deal. The reason Tesla is actually selling off today is apparently the Wall Street Journal did an investigation that, quote, uncovers alarming flaws in Tesla's autopilot leading to crashes. The Wall Street Journal on Tuesday published a critical video about Tesla's driver assistance systems, highlighting long-standing concerns regarding the company's camera-based technology. The video, which represents a part of the journal's comprehensive investigation into Tesla's autopilot system, suggests that the technology has been a key factor in several crashes, some of which have been fatal. Specifically, the investigation gathered data and video from more than 200 Tesla autopilot crashes, revealing how the driver assist algorithms process inputs from Tesla's vision cameras in real time. The video highlights a fatal accident from May of 2021 involving Steven Hendrickson, who was driving his Model 3 in autopilot mode on his way to work. An overturned double trailer appeared on the highway, which Tesla's system failed to recognize, resulting in a full-speed collision that killed this individual. Wall Street Journal says, quote, the kind of things that tend to go wrong with these systems are things like it was not trained on the pictures of an overturned double trailer. It just didn't know what it was, said experts who reviewed the footage. The Wall Street Journal video points out similar issues where autopilot misinterprets the lights of emergency vehicles, leading to crashes. The Wall Street Journal cross-referenced individual state accident reports with the federal database maintained by the National Highway Traffic Safety Administration and reenacted 222 Tesla crashes. Of these, 44 incidents occurred when Teslas on autopilot veered suddenly, and 31 happened when the vehicles failed to stop or yield, when the latter causing the most severe accidents. Analysts who reviewed the crash footage and autopilot's system's algorithmic operations indicated it would take time to train the system to handle all road scenarios. So let's establish a couple of things right now. The Wall Street Journal is very biased. They're going to talk about how many crashes Tesla's autopilot system has had, but they're not going to talk about how many lives that were saved with the autopilot system or with FSD in general. There's far more lives that have been saved over the years than have been lost. In fact, there's less than a handful of lives that have actually been lost due to autopilot, in stark comparison to the amount of lives that would have been gone otherwise. If you actually think about it, 200 crashes or 222 crashes since autopilot's really inception, that's a good number. That's as bad as that sounds, right? People losing their lives, not good. But that's a very low amount of crashes for how long autopilot has been around. I mean, it comes standard in every Tesla. Like, there is millions of Teslas out on the road today. And number two, which is the probably most obvious part of all of this, these are looking at old crashes, old data. If we look at new data, autopilot is far better than what it was even back in 2021. Like 2 to 3 times better than it was back in 2021. So you're not seeing these same issues on today's software. So it seems like the Wall Street Journal is trying to make an old problem today's problem for Tesla. And this article today is really censoring some of the other good news that we've seen today, and we'll talk about that in just a moment. But apparently Gene Munster is falling for this a little bit over on X. His 4 key takeaways. He says he believes eventually autopilot will be discontinued once FSD is ready. And actually that may not be a bad thing. Give everyone a free trial of FSD. Don't offer autopilot. I'm sure take rates do improve. So I don't have too many negative things to say about that. But he says eventually Tesla will have to add more sensors to the autonomy stack. And this is where I think a lot of people would disagree. I think a lot of people would look at the progress we're seeing with FSD today. I mean, look at data from years ago. That doesn't matter. What does it look like today is the question, and dramatically more improved is the answer than it was then without LiDAR or other sensors. Sure, could Tesla add a sensor or two if they feel like it? Sure, why not? Can't hurt anything. But do you have to be retrofitted like a Waymo with big, cameras and huge sensors all over the car? Absolutely not. And Gene Munster is essentially saying that Tesla will have to add sensors, and I don't think that's true. I mean, after all, Tesla's making more progress than other self-driving car companies by a long shot without all of the additional sensors. And again, if you're training a software on real-world situations and or simulations, sensors can start throwing off things everywhere. I mean, for an example, think about a car that is flying on the highway going 120 mile an hour and next to you, right? And it's coming to pass you. If you're relying on sensors, your car may say, hey, there's no car next to me. I can get over. You're going to get over right in the way of this car that's flying, instead of having the system that can judge and say, hey, this car's going too fast. We can't get over right now. That's just one of many instances I can point to where the visualization stack that Tesla is developing is far superior to sensors. Sensors, they're not going to think like a person would, like a logical individual. They're going to say, hey, this plus this equals this, and this plus this equals this could be wrong. In the scenario that I just gave, sensor would just merge you over right into a car that's going way too fast on the highway. Just for an example, there can be many other examples of this, but that's just one that pops to mind. He says, number 4, eventually autopilot will eventually be taken off the road and replaced by FSD based on the simple principle that humans are becoming increasingly disgraced drivers and the world will be a better place with autonomy. According to NHTSA, 41,000 people died in traffic accidents in 2023. Again, it may not be a bad thing if autopilot is discontinued as FSD gets better and people get free trials of FSD. They may just opt to, get the FSD instead of maybe otherwise just keeping autopilot. And then he says, number 4, this is a bad look for Tesla and will stoke the debate related to the feasibility of autonomy. And I think any logical investor would say, this is old data. You want to look at data from now, specifically from after V12 or V12.3. Any other data, if you're looking at 0.4, if you're looking at 0.5 and we're having these issues, then I could say maybe Wall Street's going to look at Tesla differently. But I don't think Wall Street cares about data or accidents from 2021 in regards to today's autonomy at Tesla. And I really don't say that to be insensitive, because you may care about that data, you may care about those accidents from 2021, but Wall Street is the most ruthless place you'll ever encounter. I mean, Wall Street just does not care about much. And I actually think most of this drop you're seeing in Tesla today, yes, it started based on this Wall Street Journal report, is actually fueled by the selling that you're seeing in the rest of the markets. The S&P 500 at the time of recording this video is down 0.72%. But take a look at your big tech, specifically Nvidia. Nvidia is down 6% today, guys. Microsoft is down 1.4% today. They report earnings today and after hours. Amazon is down almost 1%. Meta's down almost 1%. Apple's down almost 1% today. This is causing a lot more selling than you would otherwise see, mostly via algorithms in Tesla stock. And there are a couple of different reasons for this today. Number one, you have Jerome Powell tomorrow, and you have Microsoft and AMD earnings today in after hours. It's pretty common to see a little bit of a sell-off before you get major catalyst and events, because you're pricing in some risk here. So there's risk heading into Jerome Powell tomorrow that he's maybe not as dovish as Wall Street expects. That's not great, right? That causes some selling today to price that in for tomorrow. Also with Microsoft and AMD earnings, this mentality right now is sell first, ask questions later. And some people are getting ahead of that. And that just creates more selling in other areas of the market. About 80% of the trading volume that we see is algorithmic, right? It's computers in offices doing trading without any humans there at all. So these computers, I mean, they're selling off Microsoft, they're selling off Tesla, they're selling off the S&P, they're selling off Nvidia for sure. So that's important. I would say that's number one. Number two is the Bank of Japan is considering additional interest rate hikes, including raising interest rates to around 0.25%. This news came out at 11:18 in the morning this morning, and it coincides perfectly with when the S&P started to really fall. Now, why would the Bank of Japan raising rates be a negative for equities? Well, in case you don't know, I know a lot of you guys may have grown up hearing this saying that China owns us, China owns the US. Maybe that's just me. Maybe I grew up hearing that way too much and you did not. But no, China does not own the US. Nobody owns the US, number one. But if you wanted to say someone did own the US, you should say Japan, because Japan is the single largest owner of US debt, foreign owner, that is, of US debt. They own over $1 trillion worth of US debt. Now, why is that? Well, no. Number one is it's clear the U.S. is the best place to invest your money if you want to keep your money compared to other countries out there. The U.S. is not going to go bankrupt anytime soon. It's just the gold standard for other countries investing their money and buying treasuries. So that's one reason. But when you get to the heart of this, Japan's rates have been low for a very long time. Japan has actually struggled with deflation more than inflation. Now Japan's starting to see inflation. They're starting to begin the process of raising rates. Well, gee, what happens when Japan starts to raise rates, the largest owner of U.S. treasuries? Well, some Japanese investors, corporations, or individuals may say, we don't want to invest our money in the U.S. anymore. Maybe we should take some of our money out of U.S. bond markets and start to buy Japanese bonds again. And we haven't had that in a very long time. So what that does is it creates more selling pressure for our bonds. Now, what does selling pressure do for bonds? Well, look at TLT. Okay, this is the simplest way to think about it. If you look at TLT, this is an ETF that tracks the 20-year treasury. If you get more selling that comes in to this ETF, let's say, the price is going to fall. What happens when the price of bonds falls? The yield goes up. So it can push upwards pressure on 10-year, 20-year, 30-year treasuries. So basically higher treasury yields. Now, 10-year treasury yields today are not reacting to this too much. You're down about 1 basis point to 4.16%. But Wall Street is starting to get a little bit more concerned. If Japan does need to raise rates, that could be negative for our bond market. And the third thing that is really affecting our markets today is the JOLTS job opening. So last month we had JOLTS job openings at 8.14 million. It was revised upwards, not downwards. So usually it's revised downwards. The number was taken up from 8.14 million to 8.23 million. Now we were expecting a flat 8 million job openings for June's number. You came in at 8.184 million. So higher than expected, showing there's more slack in the labor market. There's more jobs that need to be filled. There's more hiring that can be done. And that's not exactly great. Is this the end of the world? Absolutely not. But it does go to show that maybe there's not as much pressure on the Fed to start lowering rates. Now, you also had the CB consumer confidence for the month of July that came in higher than expected. We were expecting a number around 99.7. We came in at 100.3. So people are feeling a little bit better about the economy, about where they're going to be in the next 6 to 12 months. This is the CB consumer confidence. So consumers feeling a little bit more confident is always going to be a good thing for the economy. Good thing for the economy is not necessarily good for markets' expectations for Fed policy. Now, I will say it's not moving around expectations for what the Fed is going to do basically at all. The probabilities for the Fed to cut rates September 18th are literally the same as they were yesterday, but there's some investors that are starting to doubt how strong Powell's going to come on coming tomorrow, signaling a September 18th cut. Because let's be honest, it's all about the signaling. Does Powell say, hey, it's appropriate to start cutting rates? Or does Powell say, we're going to be data dependent? Data dependent means bad news. Powell just outright saying it's appropriate to start cutting rates is going to be good. And markets are priced for that. Markets are priced for the latter. They're priced for a Powell that confirms a September 18th cut. And that's a risk heading into tomorrow. We'll talk about that a little bit more in the next video and go more in depth on this. And let me just tell you, you do not want to miss it. So here's a little bit more of good news for Tesla today. It says, according to local news, the construction rate of Tesla's China Shanghai mega factory has exceeded 30%. So you're already 30% done with the Megapack factory over in Shanghai. Once this thing is up and operational, Tesla's energy numbers are going to explode even more because Tesla's already taking backlogs for 2026 for Megapacks. And as Elon Musk has said before, there's basically infinite demand for Megapacks because every power plant in the US could use one. I mean, even wind turbines and solar fields, all of that could use a Megapack. Now, it's also being reported that Dawa Capital has increased their Tesla price target to $225 per share from $180 per share. And this is the analyst. He is a almost 4-star rated analyst, ranked number 2,520 out of 8,964 Wall Street analysts. So he is in the top 25% of Wall Street experts with a success rate of 60% and an average return of about 9% per rating. Jim Cramer just said this about Tesla today. He says, quote, I don't regard Tesla as an auto company because of its technology, and I like it for tech. As well as that, software issues at Volkswagen have delayed the new ID4 EV to 2029, and Audi has reportedly gone to China for a new vehicle platform. Volkswagen's software division is still puzzling its way through code that won't do what's required. And unfortunately for the competition struggling is good news for Tesla. Option activity today from big money via the interesting flow sentiment today. You have seen 3 different trades totaling $505,000 with a positive order value of 100%. And we have some pretty big trades here. If you take a look, this is a September 20th, 225 call worth $7.38 million. So that's a very large trade. $18 of premium paid. So that puts your break even at like 242 or so by September. So it's a pretty bullish trade considering you're about $20 out the money, and that's a $7 million trade. You also have some October 18th $200 puts here coming in for $2.06 million and $2.05 million. But these could actually be some firms selling the $200 put for October 18th, which would make quite a bit of sense because your break even would be around 190 for Tesla. And I don't think a lot of firms expect Tesla's going to go that low that quickly. The short position in Tesla today is sitting at 3.76% short interest of free float, $24.22 billion currently sold short in Tesla stock, totaling 104.34 million shares. And you do see today cost of borrow fees about 1.47%, borrowed shares 715,000, return shares 678,000. That means you do have a borrow change of about 36,000 shares potentially being sold short today. Tesla sentiment over on StockTwits today is bearish at 40. Yesterday, you were bearish at 42, so retail feels a little bit more bearish today than they did yesterday. Message volume today is normal at 48. Yesterday, it was low at 44, so message volumes picking up a little bit, and the participation ratio today is normal at 54. The percent of stocks currently trading above their 50-day moving average today is at 66.5%, largely unchanged from yesterday. You are seeing about 1% of all stocks breaking below their 50-day moving average, but considering just how red the markets are, I think that's a pretty good day. We do also have the CNN fear and greed indicator today that is at 41, which is indicating some pretty fearful conditions, or at least starting to get more fearful. Yesterday, you were neutral at 45, so you went from neutral to fear based on today's move. And we'll talk about this a little bit more in depth in the next video. Tesla stock is now down north or south, I should say, of 4.2%, which is getting pretty brutal. But you're right back in this channel of these trend lines. I wouldn't get concerned until Tesla really breaks under like 217, 218, 217 or so. That's where things start to look worse, and that's where you could be targeting downside down to about 205. Although that's not my base case expectation, that is possible. I should also mention what other individuals have mentioned is we finally got a golden cross where the 50-day moving average has broke above the 200-day moving average. That has not happened in, I mean, over a year. The last time this happened was, let's see, back here around June of 2023, and this did lead to about 25% additional upside for Tesla stock. And typically when you do get this golden cross, it does lead to a lot more upside. So if that is true again, you could potentially send Tesla, if we just look at 25% higher, could potentially send Tesla back into about the 280s or so. But I think Fed Jerome Powell is a big catalyst we need to get out of the way before we get large material upside from here. And again, we'll talk about that more in the next video, so stay tuned to the channel for that one. In the meantime, hit the like button and subscribe to the channel if you made it to the end of this video. If you guys do want to come trade with us live in real time as well, check out that link down below in the description of this video. Did a lot of trading today, got a bunch of free contracts for earnings. We're going to have a pretty jam-packed earnings today in after hours. You're going to have Starbucks, you're going to have Microsoft, AMD, Arista, as well as some other smaller companies. So AMD and Microsoft are obviously the big dogs, but some of those other guys can be important and potentially big movers as well. So you guys enjoy the rest of your day, and I will see you in the next one.